Welcome to this tutorial about managing foreign currencies in emerging markets. Emerging markets have become pivotal in shaping international trade dynamics in an increasingly interconnected global economy. Over the past decades, these markets have transformed from peripheral players to central figures in global commerce. Characterized by rapid industrialization, expanding consumer bases, and unique competitive advantages, emerging markets like China, India, and numerous economies in the Middle East, Asia, Africa, and South America are not just participating in, but actively reshaping the landscape of global trade. This module delves into the growing influence of these economies, examining their integration into the global market and the challenges and opportunities they present for businesses and their finance teams. Emerging market economies have been a transformative force in the world economy for several decades. China consistently ranks as the world's largest exporter of goods, while other EM countries like Vietnam and India have also seen substantial export increases. In 2020, the World Trade Organization, WTO, reported that the combined merchandise exports of EM countries accounted for more than half of the world's total exports. As these economies continue to liberalize trade policies, modernize infrastructure, and enhance their manufacturing and service capabilities, they present growth opportunities for international businesses seeking new markets and partners. The rise of e-commerce and digital platforms has made it easier for SMEs to access international markets, including emerging market economies. Online marketplaces and digital marketing tools have lowered barriers to entry, allowing anyone to reach customers and suppliers in these markets more easily. Products and brands such as fashion and beauty or innovative technologies, ranging from renewable energy to pharmaceuticals and medical devices, are in growing demand in EM economies. Businesses of all sizes, including small and medium-sized enterprises, SMEs, increasingly engage in servicing this growing demand. Many governments, including the UK, and trade organisations also offer support and incentives to SMEs exporting to EM economies. These programs can provide financial assistance, market information, and trade promotion services, and contribute to trading opportunities with emerging markets. Yet, despite these opportunities, businesses should be aware of specific challenges when dealing with emerging market economies. Emerging markets are incredibly diverse in terms of their economic characteristics and the challenges and opportunities they present. This diversity arises from various factors such as geography, culture, economic development, political systems, and resource endowments. From more advanced emerging economies such as China, India, Saudi Arabia, South Africa, or Mexico, to so-called frontier economies in Africa or Central Asia, many countries present typical challenges for growing economies. These economic challenges translate into specific financial risks that the currencies of these economies are exposed to as a result. Current account deficits. Some EM countries run persistent current account deficits, meaning they import more than they export. Such deficits can put pressure on their currencies, as they may need to rely on foreign capital to finance the deficit. Suppose international investors don't purchase the EM currency at prevailing exchange rates because of concerns about such deficits. In that case, that currency will likely weaken to the levels where investors see the risk-reward ratio as attractive again. Higher sensitivity to financial market sentiment swings. EM markets are more exposed to market swings. They often offer higher expected returns, so-called interest rate carry of investing in local currencies, which puts them in greater demand when markets are in a positive mood. Conversely, EM currencies also tend to suffer more during periods of market risk aversion. Inflation. High inflation rates in some EM countries can erode the purchasing power of their currencies. High inflation can also lead to currency depreciation, as investors seek assets in currencies with lower inflation risks. The graph shows the values of both the Indian rupee and the South African rand falling over time against the US dollar, which is quite typical for EM currencies. Higher inflation is one of the reasons why both currencies have steadily depreciated over time, as both countries had inflation at levels that were twice that in the US. Hyperinflation is a special case of an inflationary environment where high inflation expectations become self-fulfilling, and everyone expects a continuous fall in the value of money. Public and businesses avoid holding cash in the currency as it loses value on a daily basis, often faster than interest rates paid on the deposits. As a result, EM currencies tend to experience more significant fluctuations in their exchange rates compared to major currencies. Countries choose various ways to protect their economies and currencies from global economic shocks. Nevertheless, in many cases, currencies serve as a release valve that helps remove economic imbalances. Many EM economies have some form of capital controls: China, India, South Korea, Brazil, Russia, South Africa, Turkey, etc. Capital controls are imposed by governments or central banks and restrict the ability to use, exchange, or convert the currency for specific purposes, such as international trade or investment. Controls can create challenges for businesses and investors, as they may impact the ease of doing business, the repatriation of profits, and foreign exchange risk management. Capital controls can come in different forms. A full restriction to buy or, more frequently, sell an EM currency in exchange for hard currency. Limits on capital amounts that can be transferred to from other jurisdictions. Requirements to provide documentation that justifies the need to purchase or sell currencies. Exchange rate controls are another method used by central banks to regulate currency markets. For example, countries like China or India have authorities intervening in FX markets to keep the exchange rates in a specific range. Such interventions are part of a loose version of exchange rate controls called a managed float, where a currency can fluctuate freely within a defined range. Pegged currencies such as the Hong Kong dollar or Saudi rial have their currencies trading at fixed exchange rates to another currency, usually the US dollar. Other currencies may have a crawling peg, where the exchange rate gradually changes. There are other risks of doing business with emerging markets. Political and economic instability. Many emerging markets are characterized by political instability, government policy changes, and economic uncertainty. These factors can lead to abrupt currency devaluations or restrictions on cross-border flows. Geopolitical risks, such as trade wars or real military conflicts, can significantly affect the economic situation of a country and its currency. Weak public institutions in a country can directly and indirectly affect its economic and business environment, including the value and stability of its currency. A government may, for example, implement unorthodox economic policy or limit the independence of the country's central bank, as happened in Turkey. Weak institutions and their actions may eventually lead to a significant currency devaluation if public and foreign investors lose confidence. In addition to affecting the economic environment, the above-mentioned instability and weak public institutions can also make it more difficult to conduct business in many EM countries. There are also practical challenges of dealing with EM currencies. If you are located in the UK or another developed economy, paying suppliers or employees in EM currencies is usually relatively easy. There are often no or very limited capital controls if you want to send money to most countries. In fact, and not surprisingly, many suppliers would actually prefer being paid in a hard currency, with the US dollar remaining the most popular choice. However, local banks may charge high FX fees for converting US dollars, which local suppliers will factor in when quoting you in foreign currencies. Thus, it is worth asking them for quotes in their domestic as well as hard currency, and comparing whether buying EM currency and sending it to your suppliers could be more cost-effective. However, if your business holds assets, such as a subsidiary in an emerging market country, or simply receives revenues from sales in such a country, protecting from currency fluctuations and your ability to get the revenues from the country is likely to be harder for a number of reasons. Because of the vulnerabilities and risks discussed earlier, most EM currencies tend to have more volatile exchange rates than other currencies. For example, currencies such as Brazilian real, South African rand, or Indonesian rupiah experience currency swings that are more than twice as big as fluctuations between currencies of developed economies, especially if they are close trading partners. If you want to protect the cost of your purchases in EM currencies against currency fluctuations, forward FX prices may often be more favorable than prevailing spot prices. As a result, locking in the FX rates in advance can help you reduce the costs of these future cash flows. Conversely, hedging the value of your receivables or assets in EM currencies is often a challenge. As a result of often higher inflation and interest rates in EM countries, their currencies are expected to depreciate on a forward basis, as shown in the example for the South African rand. Currency restrictions often lead to tiered markets where prices of currencies may differ and at times result in additional costs for your business. Onshore and offshore FX markets may, at times, have different prices for forward FX rates. So-called non-deliverable forwards, NDFs, are often used to hedge currencies where access to regular forwards is restricted to overseas entities. NDFs settle a cash amount based on the difference between a booked forward rate and a fixing rate on a specific date and can help protect from currency fluctuations. However, the fixing rate is usually based on a central bank rate or an industry-agreed fixing standard, which may differ significantly from the actual rate you can get when converting the EM currency. As mentioned above, capital controls may restrict your ability to remit funds from an emerging market country. In some cases, you may be required to provide sufficient documentation to evidence the source of the proceeds. This can add to the costs of doing business in the country and cause delays in your ability to access funds. In more extreme cases, proceeds from sales or investments in local markets can get trapped for a prolonged period due to capital controls. In the short term, this may not be a problem, as you may use the funds to reinvest into local activities or acquisitions. However, this is another risk of working with emerging markets and needs to be thought about strategically and monitored if the amounts are large. In conclusion, emerging markets represent a complex yet dynamic facet of the global economy. Their diverse economic characteristics, coupled with unique challenges such as currency volatility and political instability, require careful navigation. However, these markets also offer substantial opportunities for growth, innovation, and expansion. Businesses venturing into these territories can benefit from their burgeoning consumer bases and competitive advantages, but must remain cognizant of the inherent risks and practical challenges. The continued evolution of these economies will undoubtedly play a crucial role in shaping the future landscape of global trade, demanding adaptive strategies and informed decision-making from international businesses and finance teams.